Well, we've certainly seen a rally across global yield curves, and as was pointed out, the German Bund hitting negative 20 basis points is an eye-popping number for us. What we have said since the beginning of the year is that we wanted to focus on, since the beginning of the year, the tight range that the 10-year Treasury was trading in. And instead of making a call at the beginning of May as to the exact direction, we wanted to take a view that volatility in rates would go up. And as Jeffrey expressed on your program with Scott Wapner, we expressed our view through the volatility in interest rates. And since Jeffrey presented that trade, volatility has gone up markedly. Going forward, I think that we've seen a big rally so far. There's a lot of expectation for Fed cuts. I think we're pricing in 70% chance of a Fed cut by September and greater than a 60% chance of 2 cuts by the end of the year. And so the Fed, is really caught in a tough position. This needs to be also, what we also wanted to look at is internationally, due to the low yields that we've just pointed out, there's been a lot of buying of foreign investors into U.S. assets, and a lot of that has been unhedged. So rather than expressing an outright view in rates, one thing that I would like to point out is the surprising move in the U.S. dollar. Ever since the trade war picked up and the trade rhetoric picked up in the past month, the dollar has actually remained fairly contained compared to what the rhetoric actually has been. Even today, we saw a sell-off in the dollar. And I think going forward in the second half of this year, we would be a little more biased to advising investors at this point when we look at risk reward to potentially start looking at non-dollar investments. And instead of looking at any one particular currency or country, use a basket because there are a lot of idiosyncratic risks out there.